And we want to get immediate reaction to the housing numbers and what they say about the economy. David Dahl helps manage about $2 billion as chief executive of Canally Trust. He joins us live from Houston this morning. Hi there. So a better than expected number. Are you surprised?
Hey, Lori, good morning. Yeah, a little bit surprised. Last week's number that was weak, down 9%, and then coming in this morning with a positive number. That's a little bit of an uptick surprise-wise. What's really important here is that the existing home sales, that's 85% of the market. The new home sales are only 15%. So to get a good number, as we've seen here this morning on existing home sales, that's an important variable for us.
David, you think this is a bottom in the home crisis?
Absolutely not. It's hard to recall, but we actually peaked in terms of home sales back in the summer and fall of 2005. So we're 2 years in the making now. Even with this morning's number, we're still down about 30% on existing home sales from that peak. We're down about 50% from new home sales from that peak, showing us that the housing recession is going to continue well into 2008.
And we learned last week that home prices are down 6% according to the Case-Shiller report. So we've got, as you're talking about, a bottom ahead of us. So will this lead to an overall recession in the U.S. economy?
Well, we don't think so. The economic data that we've seen so far doesn't point to it. News and housing isn't good, that's for sure. But just take a look at retail sales and some figures. Even though a lot of people would talk about middling data through the holiday season, up 4% isn't the stuff of a recession.
Watching the stock market in 2007 gave me whiplash. What's ahead for the new year? Will we see such volatility?
Yes, we'll see volatility continue, most likely because of politics as we kick in for the 2008 elections. But let's just talk about this week, because for a holiday-shortened week, we've got a lot of key data coming at us after the New Year's, and it's all about jobs. Wednesday, we're going to get a peek at the ISM report. Thursday, we're going to see weekly jobless claims. We're also going to get to see the biggest job of all being the Iowa caucuses on Thursday and what's going on there. And then on Friday, as you talked just a few minutes ago, we're going to see some employment non-farm payroll data for the month of December.
And from our earlier chat, David, you seem to think that the economy and the economic data that we're getting right now is consistent with an economy that's holding up, despite what some people are saying, forecasting perhaps a recession. So what are you looking for specifically for the jobs report Friday?
Pardon me, absolutely. The economic data doesn't suggest that recession is imminent right now. The 70,000 figure that you've quoted, consensus, is what we're looking for. But I tell you, we have seen some slippage in the weekly jobless claims. We're cresting up towards 350,000 on that Thursday morning report. The 4-week rolling average has been moving up since September, now up above 340,000. You noted that jobs added this year around 1.4 million is the slowest in the last few years. So we're really keeping an eye on job growth because it's the linchpin from where the economy goes in 2008.
Where does the Fed go in 2008? What are your forecasts for interest rates? It looks like, well, just from the data this morning, yields are coming down now. So perhaps we've seen an end to interest rate cuts, or are you looking for the Fed to go further?
I want to be consistent with you, Lori. As long as we've got a separation between the 90-day T-bill, which currently today is around 3.15, and Fed funds at 4.25, we see the Fed going to continue to lower rates as we move in 2008, meeting after meeting, at least for the time being. Some of the inflationary data of late may have been a bit of a concern, but this T-bill rate, the last time we looked, we had a very sharply and steepened yield curve. That's not the stuff of recession either, and it tells us the Fed has plenty of room to continue to cut.
Where do you want to see that spread, that 90-day T-bill or Fed funds?
Well, ultimately, you want to get them close to parity because the spread tells us that the bond market thinks a little bit differently than Fed funds. And right now, when we look at the yield curve, the one rate that's stubbornly high is Fed funds, and with it, some of the money markets. The rest of the yield curve is behaving properly, starting with the 90-day T-bill all the way out to the 30-year.
Where will Fed funds bottom out in 08?
Probably close to around 3%. We see a bunch of Fed meetings in the first part of the year. Recall now, it's been about 5 months since the Fed began, and we should start to see the action and reaction of the markets and of the economy overall to these Fed reductions somewhere along around the spring, early part of the summer.
So given this economic climate you've outlined for us, what areas do you like for investment?
Well, we continue to like international investing. As long as the Fed is reducing rates, we don't see the ECB at the point that they're going to be reducing rates. We have seen a little bit from Canada and the UK, but as long as the Fed is reducing rates, we think that international investments are going to continue to do well. We like basic industries, continue to like those, and we also like technology and healthcare. We think they represent a good value at this point in the election cycle.
Dollar weakness has sure helped some of the multinationals, perhaps some other international plays from U.S. investors. Where do you think the dollar's going? A lot of people are forecasting a firmer dollar in the new year.
Yeah, we'd say the same, and the reason for that is even though the ECB isn't at the point that they're lowering rates, we've seen some stabilization of late in the dollar. As I mentioned, Canada and the UK lowering their sovereign rates. From our standpoint, the dollar has a little bit further that it might decline, but it's stabilizing. We wouldn't be in the camp that would suggest a strong bearish bet on the dollar in 2008.
So, David, we are covering all sorts of ground here today. And before I let you go, before you go celebrate the new year here, what areas do you dislike? What should I avoid? What about financials in particular?
Oh, there's more bad news to come there. Some of the recent reports talking about write-downs totaling up over $100 billion, those may still be conservative. We continue to avoid the financials. We avoid some of the consumer discretionary-based stocks, especially those that are impacted where energy prices are taking their toll on pocketbooks for the middle and lower-end consumer. So those are two areas as we begin 2008 with a little bit of weakness that we'd be away from.
David, we sure appreciate you joining us on this New Year's Eve day. Have a terrific holiday.
Same to you.
David Dahl of Canale Trust Company.